So guys, now how does behavioral finance impact the market? See, first of all, what is the meaning of the market being efficient? It means that the market prices of the securities should be approximately equal to their intrinsic value. Sometimes that's not true, which means the markets are not efficient. And this is known as an anomaly. Now, what could explain that behavior is what we have studied, right? Behavioral finance could explain inefficiencies in the market. So let me repeat that. Behavioral finance can explain inefficiencies in the market, but we will look at alternative explanations before we get into the behavioral finance explanations. So first we will talk about what market anomalies are, and then what are some alternate explanations of why we seem to observe these anomalies, and then we will get into the behavioral finance explanations of those, right? So first of all, what is a market anomaly? It's an inefficiency in the market, or it is a deviation from the efficient market hypothesis. Why would that happen? Explanations which are apart from your behavioral finance. So of course, we will look at the behavioral finance explanations as well, and how the behavioral biases could lead to inefficiency in the market. But let us first look at the possible other explanations of these anomalies. First of all, if you're saying that the market price should be equal to the intrinsic value, well, how do we calculate the intrinsic value, right? What is the intrinsic value? Isn't it the present value of future cash flows, right? And how do you calculate the present value of future cash flows? You would take those future cash flows and you would discount them back to today. Now, the discount rate that you're going to use, where does that come from? If it's a stock that you're calculating the intrinsic value for, well, then it's equity, and this will be the required return on equity, which is calculated through the capital asset pricing model, right? And you know that the capital asset pricing model has been observed to be not very realistic. The projected required return on equity based on the beta of a stock has been different than what that stock has actually returned in reality going forward. So, of course, there is a shortcoming of the underlying asset pricing model. Another reason could be that you've observed an anomaly, but actually that anomaly is not there because you've just taken a very, very small sample, right? And if you zoom out a little bit and look at the bigger picture, you'll find that it was just a exception, right? It's just an exception. It's not a real actual inefficiency in the market. Another reason could be is that your data is biased. And how is it biased? It is biased in terms of survivorship. So let's say you start your analysis in 2024 and you take whatever stocks are available here and you look at how they have been performing and have they been equal to their intrinsic value going back, right? But what you ignore over here is, what about those stocks which have died, which were there back in the day, right? But because they're not alive now, those companies are gone, so you didn't make them a part of your sample. So the sample that you took are only those companies which have survived. So you ignored those companies which have actually already just gone bankrupt, right? So this is that your data is biased, and therefore you whatever conclusion you have come to is not really something worth looking into because you didn't do your sample selection properly. And then we have our data mining bias, which again is a sample issue, because let's say you do your analysis from 2010 to 2020, and you're able to find some anomaly in this time. But then if you check it from 2000 to 10, you find that anomaly doesn't exist. So it was only in your sample, but when you test it out of sample, right, when you test it out of sample, it's not there. So therefore, what really happened in your particular sample is that you just kind of forced the data into submission by trying to find some kind of a inefficiency in the market, which is just particular to your data set. But if you try to check it outside that data set, it doesn't happen. Or even within this time zone, maybe you took one particular set of companies, but if you take another set of companies within that time zone, you might find that the inefficiency doesn't exist, right? So it could be just specific to that data set only. And of course, that yes, maybe there is an inefficiency, but it's just a temporary thing, a one-time thing. It's not going to last, and it's not a permanent inefficiency in the market. So these are all possible other explanations, but we are more interested in the behavioral finance ones. And I personally really like the momentum because, well, you can then sell when things get overvalued, right? You can sell them above their intrinsic value. So let's say there's a stock, and let's just take a random example. Let's say Tesla. Intrinsic value is 200, right? Just giving an example. And let's say it was at 100 and starts going up, but it starts going up really fast, develops a momentum and shoots past its intrinsic value and goes to 300. And why does that happen? Number one, availability bias, recency effect, that everyone's like, oh, Tesla's going up, and on the news everywhere, and your friends and in your social circle, everyone's talking about Tesla, and it's like what you hear, and everybody starts getting FOMO then, right? Fear of missing out. And the same thing with Bitcoin. So it's like a trend chasing. You don't want to miss out. And this is not regret in the sense that when we talked about in the previous bias that we said, oh, we don't take a decision because we don't want to regret our decision, and we're thinking of making a mistake. Here the regret is more towards missing out, right? The fear of missing out. And we don't want to regret missing out later, so we buy in. And actually, a lot of people actually start buying in where the stock is above its intrinsic value, where you actually should be selling. But then it just shoots up because there's this momentum that has developed. And then what happens is that it comes back down, right? Maybe even develops a negative momentum and would go past the intrinsic value again. So these create inefficiencies in the market because it gets overvalued, which means the price of the market price of the security becomes more than its intrinsic value, and then it gets undervalued as well. So this is called momentum or trending effect. Another very interesting one is bubbles and crashes. Here again, what's really going on is that euphoria that creates that bubble where everyone's like, oh, we're invincible, and we are the ones, who are just, we know exactly what we're doing, and our analysis is perfect. So overconfidence, self-attribution, and you ignore all the bad news. And I've gone through this, so I still remember when once the market was in a really huge bull run, and we were just all feeling invincible, and then there was an economist who was telling me that, what are you guys doing? This is overvalued now. I mean, if you look at the numbers, it doesn't make any sense anymore. And we were like, yeah, whatever, because at that point you don't want to listen to anything which doesn't conform to what your existing views, because you don't want that cognitive dissonance, right? And obviously you don't want to miss out, so there's that FOMO as well. And then what happens is that you don't listen to people who are telling you that, hey, this has gotten way overvalued, right? And then suddenly you realize that, oh, there is actually a huge mispricing here, that if your intrinsic value was much lower and you have come a long way above your intrinsic value. And as that realization sets in and the momentum kind of slows down, it's like up the stairs and down the cliff, you know. So that's what we say in the markets, up the stairs and down the cliff. Now this third one, value, I think it's not really there anymore, right? So I mean, Eugene Fama and Kenneth French, they did their analysis quite a long time ago, and what they found out was that value stocks tend to do better than growth. Now what that means is, what is value? Price over earning is lower, right, compared to growth, which price over earning is higher. And let me give you examples. So let's say Exxon, very big company, right? Earnings is solid today. Netflix, also a good company, but much smaller than Exxon, right? However, the price of Netflix is, I mean, if you look at the market cap, it is huge, which means the PE ratio is much bigger, maybe, I don't know, 10 times bigger than Exxon. I don't exactly know what it is right now, but let's just take an example that if Exxon is at a 10x, Netflix is probably like at 100x or something. It keeps going up and down, but it is having a very high PE ratio. Why that is because the market is giving this such a high price, not based on today's earnings, but future expected growth in earnings. So if they expect that the earnings will grow 10x from here, so that's why in a way they're actually giving them both the same multiple, right? If they assume that Netflix earnings will grow and Exxon earnings will either stay the same or reduce, since oil and gas is going to, of course, have to take a hit as climate change becomes more of an issue. But the point here is that Fama and French found out that usually what happens with these growth companies is that they get overvalued, they get overpriced, and in reality the growth in earnings is not that much. So, and the reason why they get overvalued or overpriced is because there is a halo effect, that we treat them as saints, that, oh wow, look at these new growth models, and Netflix, the subscriber growth is just not going to stop, and you have overconfidence in them, right? Home bias, you can resonate to those companies, you use their products and services, so you just believe that, yeah, this is like the best thing and it's going to go on forever. But then Disney comes out with its streaming service and Amazon Prime starts increasing, and then you know, these other streaming services are there. Apple TV comes out, not that it's doing very well, but I mean, the point is that Netflix has not seen the subscriber growth that we once thought that it was going to. So that's what Fama and French are saying, that, you know, you overprice these growth stocks, but then later what happens is that they don't tend to do that well. Whereas on the other hand, you've got your solid established value stocks, which you were just beating them down because you thought, oh, it's over for them, until you realize that no, it's not over. The world still needs oil and gas, and you know, it's probably going to be around for another 50-100 years. So and therefore what then ends up happening is that the value stocks then outperform the growth stocks. So this has been happening. So this is true. Will it continue to happen? I don't know. Maybe this is one of those anomalies that is the, you know, sample size sort of a thing, that okay, maybe it was true, but now the growth is just so strong in these newer business models that the oldies, the value stocks can't really keep up with that. So, you know, these anomalies are not permanent features. They could change. But anyways, what you need to know for the exam is that this is one of the market anomalies, that value stocks tend to outperform growth stocks, which means if you invest in value, then you can outperform the overall market. And why this happens? Because of these biases, which is we sort of glorify the growth stocks too much and treat them as saints and have too much confidence in them, which leads to their overvaluation, and then later they don't seem to perform that well. So that is it for this very interesting learning module. I, of course, have a special interest in behavioral finance because at the end of the day, nothing like outperforming the market, right? And to be able to outperform the market, you need to find those inefficiencies. Because I mean, if the market is going to be efficient, then buy and hold is the best strategy, and well, the clients can do that on their own. They don't need us. So as active managers, or even as partially active managers, right? So I mean, now there's a whole spectrum between active and passive. You can be just a sector rotation, you can be a smart beta strategy. So the point is, you need to outperform the market, and you can do that if there is inefficiencies in the market. And the best explanations for those inefficiencies are the behavioral finance, behavioral biases that cause those inefficiencies. So you can, buy from the pessimist and sell to the optimist, and therefore create that. So just coming back to the Tesla example, that I mean, if it's going from 100 to 300 because of momentum and then crashing back down, so you know that the intrinsic value is 200. So I mean, there's such an easy trade here for you. So this is the whole point here, that understanding these biases and then seeing them play out in the market could be gold. Nevertheless, we need to prepare for the exam right now, and therefore let's go through this summary together. So behavioral biases, you can classify them into cognitive and emotional. Within cognitive, you can further classify them into belief preservation and information processing. And emotional ones are your LOSER, L-O-S, where's the other S? S-E-R, right? And by the way, for your belief preservation, you could do CC-RE. So, I mean, if that works for you, CC-RE. And these acronyms are a very good way of actually trying to remember these names of these biases, and for that matter, any other things that you'd actually need to memorize. And whatever acronym works for you. So if CC-RE works for you, that's fine. If you want to play around with the words and then make something that's easier for you to remember, that's okay. But this one I believe is pretty good, right? LOSER. Because emotional biases definitely lead to losses, right? Because you let the weeds grow and you pull the roses out. So cut your losses short and let your profits run. And then of course, we had detailed discussions of all these biases. Conservatism is that you just hold on to your prior view. Confirmation is you look for information that confirms your existing belief. Hindsight is you overestimate that, oh yeah, I would have sold here, or I would have bought here, thinking that it's so easy to predict that. But that's only in hindsight. In reality, you don't know whether the future the price is going to go up or down, right? Illusion of control, you feel you're in control when the reality is that even the biggest best fund managers are not in control. Representative, this is a confusing one, because it's easy to confuse this one with, let me tell you, with availability, right? Availability is something which says you put more weight on the information which is easily available. That is different than representativeness. Representativeness is you take that new information, but you look at it in the perspective of your previous experience, right? So your past experience. And the point is that your past experience might not be what everybody else experiences. It's like winning in the casino on the slot machine. You might have gotten lucky, but that doesn't mean that playing the slot machine is a very good thing to do, right? So representative is about your experiences, whereas availability is about taking that information which you just easily found, maybe through advertisement or, whatever is easily available to you, whatever you're familiar with, whatever you can relate to in terms of resonate with, right? Mental accounting is treating it in different buckets, not really benefiting from that diversification benefit. Anchoring is you've got those past prices and then you just say, oh yeah, I bought it at 200 and it was 200 last year, so it's definitely going back up there. Or think of that Tesla example I was giving, right? If somebody bought it at 300 and they'll be like, oh, it's definitely going back above 300 when the intrinsic value is 200. So not to place that past purchase price and not to let that influence us. would be how to treat this anchoring bias. And framing is how the question is framed. So not just to take the probability into account, but you should also take the amount into account, calculate the expected value, and then take decisions based on that, not just because of whether the question has been framed in terms of gains or losses. And then of course you have your emotional biases. We've discussed all of these in detail. Here we don't book our losses, and that just tends to create huge negative positions in the portfolio, whereas we should be doing the exact opposite, that is cutting the losses short and letting the profits run. Overconfidence again leads to holding these positions which we shouldn't be holding. Maybe that could get into a lot of concentrated positions, or we might feel that we're the best trader and having high probability of success and just keep trading. And that of course is not good either, because we want profits, not to just generate commissions for our broker. Feeling in control when, no, sorry, this is not the illusion of control. This is self-control bias, which basically is not compromising on your consumption today and saving for tomorrow, right? Instead of saving for tomorrow, what we do is not only do we use all our income in consumption today, we even borrow. So this is failing to save enough for the future. Endowment. Getting attached to a certain asset. The solution for that is you tell the client, would you buy this asset now if you had these funds with you in liquid cash, right? Regret aversion. This is the fear of making a mistake. And because of that, either we don't do anything or we just follow what everybody else is doing. So try to differentiate not doing anything from following the crowd, right? So when we said that bubbles are happening, that is, you are doing something. It's not like you're not doing anything, but you are doing it because you are having a fear of missing out, which is also a type of regret, that you would regret missing out. But then another type of regret is you don't want to take a decision and be wrong about it in terms of buying something, right? In terms of going for risky assets. So regret aversion can actually make you too safe or too risky. When you want to be neither, you want to be just on the money. And don't be afraid of making mistakes. I mean, obviously nobody's perfect. The point is you just have to try and do your best. And then you've got the status quo, which basically is just a lazy person, right? Doesn't want to do anything. So there you have to tell them that change is the only constant in the world and you have to keep up with it. Finally, we talked about how this all impacts the market, and of course that's why we're really studying this, right? Because if there are inefficiencies in the market and they are explained by these behavioral biases, then we can really take advantage of them. So if you see a trend happening, and this is really where technical analysis can help you a lot, right? So for example, let me give you an example. If there is a momentum happening, right, you can see something called RSI, right, which will tell you that if the market is getting overbought. And then you can use other technical indicators to confirm this. But the point is, it's like throwing a ball in the air, right? It's not going to just stop immediately and start coming down. It's going to slow down first. So the rate of growth actually slows down. It's still going up. It's just that maybe it went up 10% in 1 week, then 7% in the next, and then 6%, and then 2%, and then 1%, and then it starts coming down. So if you understand these biases and then you're able to read it through your technical analysis, then you can obviously take positions on them and buy them when they are just picking up and sell them or short sell them if that's your thing when it's coming down, right? So you can really benefit from these bubbles and crashes. Value versus growth, I don't know if this still exists, but as far as the exam and theory is concerned, yeah, it exists, and it happens because we over glorify the growth companies because of the halo effect, right? We like take their prices to 100x of their earnings, and I think that's what happened to Netflix, and then Netflix came down and Exxon went up. So it does happen. Will it continue to happen in the future? Nobody knows, right? But for the exam, what you need to know is that, yeah, value stocks tend to outperform growth stocks. It is an anomaly because you can then buy value stocks and outperform the market in general. And what explains this is that we over glorify the growth stocks, which leads to their overvaluation and then eventually their underperformance. Why, by the way, we overvalue them is because we underestimate the risk and we overestimate the return. So basically you overestimate the intrinsic value because the future cash flows you are overestimating and the discount rate you are underestimating. So the numerator is larger, the denominator is lower. So overall the intrinsic value that you calculate for them is higher, and that's why you drive the market price up, only to realize that the future cash flows are not going to be that much because the subscriber growth is not there and the risk is actually higher than you thought. So it underperforms, whereas the value which you thought was the end of oil and gas, turns out it's not the end of oil and gas, and then the Exxon comes back and recovers from its low. So this is your value stocks outperforming growth. Anyways, it was really nice doing this learning module with you, and I definitely hope to see you in the next one. But more so, I hope to see you in level 2 and level 3 with more behavioral finance.